It always starts the same way. A crash hits, markets collapse, and suddenly everyone is asking the same question. Why didn't anyone see this coming? But here's the uncomfortable truth. Someone always did. Not just a few lucky investors, not just insiders. An entire class of people saw it coming and positioned themselves months, sometimes years in advance. And while everyone else panicked, they went shopping.
For decades, you've been told a story. Crashes are unpredictable, stay diversified, never try to time the market. And to be fair, that advice works, but only for one group of people. Because behind the scenes, there's another playbook, one that doesn't start during the crash. It starts 18 to 24 months before it. This isn't theory. It shows up in institutional filings, private wealth reports, acquisition data going back over 100 years. And when you overlay all of it, a pattern emerges, a repeatable one.
Let's start with the most misunderstood asset of all: cash. Not savings account cash, not emergency fund cash. We're talking about short-term government debt, treasury bills. Before every major crash, 2000 dot-com collapse, 2008 financial crisis, 2020 COVID crash, the wealthiest investors did something strange. They stopped chasing returns. They moved into assets barely yielding anything, and the media mocked them for it. When Warren Buffett held over $100 billion in cash, they called it hesitation. They said he lost his edge. But what he was really doing was simple. He was loading the gun. Because cash does one thing no other asset can do. It turns into anything at the exact moment everything else is collapsing. When everyone else is forced to sell, cash is the only thing that can buy.
Here's the rule nobody tells you. Crashes don't destroy wealth. They transfer it. From who? The panicked, the overleveraged, the unprepared. To the patient, the liquid, the positioned. And once you understand that, everything else starts to make sense.
Now we step into territory most people never even hear about: distressed debt. When companies collapse, their stock often goes to zero, but their debt? It trades at massive discounts. $1 bonds selling for 20 cents, sometimes even less. To most people, that looks like risk. To sophisticated investors, that's ownership. Because in bankruptcy, shareholders get wiped out. Debt holders take control. So when funds buy distressed debt, they're not gambling. They're positioning themselves to become the new owners at a fraction of the cost. Entire companies bought for pennies.
Now, let's go older than markets, older than banks, older than money itself. Productive farmland. Not speculative land, not development land. Land that produces food. Because no matter what happens, markets crash, currencies fail, economies collapse. People still need to eat, and that creates something powerful, a built-in floor of demand. History repeats this pattern. Ancient Rome, post-plague Europe, hyperinflation economies. When everything falls apart, those with liquidity buy land from those who can't hold it, and the cycle resets. Now we move into something almost invisible. A market that doesn't show up on your brokerage app. High-end art, but not for decoration. For one reason: true scarcity. Unlike stocks, art cannot be printed, cannot be diluted, cannot be scaled, and during crises, it behaves differently. While markets collapse, top-tier art barely moves. And here's the part nobody talks about. Most of these transactions don't even happen publicly. They happen privately, quietly, at negotiated prices that never show up in any index. Everything so far? That's defense. This next one? This is offense. The asset class where fortunes are actually built during downturns. Essential service businesses, not sexy startups, not tech. We're talking about waste management, storage units, funeral services, water infrastructure, pest control, businesses people cannot stop using even when they're broke, especially when they're broke. During a crisis, revenue stays stable, costs drop, competitors fail, and that creates a perfect storm. Buy cheap, consolidate, control the market. By the time the economy recovers, they own the system. Now step back. Look at the full picture. Before the crash, cash builds, quiet deals increase, positions are taken. During the crash, panic selling, forced liquidations, headlines everywhere. After the crash, assets change hands. Ownership concentrates. New fortunes emerge. This isn't chaos, it's a cycle. Here's the part most people don't want to hear. The system isn't broken. It's working exactly as designed, because every crash creates two groups, those reacting, those prepared, and the outcome is always the same. Wealth moves, control shifts, power concentrates. So the real question isn't, is a crash coming? Because it always is. The real question is, when it does, where will you be standing, selling or buying? If you want to understand how money actually moves, not what people say, but what they do, subscribe. Because the next cycle has already started, and most people haven't even noticed yet.